Hey everyone. So I hope all of you are doing good. So in last lecture we were discussing the CVP analysis, or more specific I can say the break-even point, where we were doing that where we have done basically one question on break-even point related to batch costing. That was a really interesting question, and that question was from CA Final study material. I hope you understood the question. Now, before starting the class, I am having some of the queries from the people, that why we are doing question from CA final study material as well. So guys, please see, I have faced the situation, so I know that the only thing which would work in this subject is the practice. Okay. When we'll solve the question, there would not be any disclaimer in front of the question that this question is from CA final material, this question is from CMA final material, or any RTP or anywhere else. The question would be a question. Okay. Basically you are given the topic, you are given the concept, and on the basis of that concept, question from anywhere can be asked. So if the concept of break even point is here in our material, in our CMA final material, definitely there would not be any restriction for the institute from asking the question from CA final material. They can ask question from anywhere. And even when we'll solve some kind of good questions now, then in the examination you will get the confidence that even you can easily solve those tough question, or easy question would be more easier for you to solve. So to clear the concepts more, we are doing question from both the material book, CA final as well as CMA final. So don't take it like why we are solving from other institute material. We'll solve from that this material as well. We'll solve from CA final material as well, and we'll solve from other materials as well, which whatever I'm having with me. Not definitely now. After completion of the course, we will solve the question from different materials, different sources, which I'm having with me, so that the concept would be more clear for you. So don't take it like why we are solving from other material. That is just a thing which I am getting from you guys. So it's very necessary to clear it before the class. So I hope you got the point. But still, if you some of you guys have that problem, that why we are solving from other material, why we are not only solving the question from this material, I would suggest you to skip the question, whichever I'm solving from other material. I can say CA final or other RTP material. You can simply skip those questions because we have just a second. Because we are solving the question from CMA final material as well. So you guys can only attend those questions which we are solving from this material. Don't solve those questions which we are solving from other materials, and solve the questions which I'm giving you in the homework from this material only. So that is a choice available to you. But if I talk about the classes, we'll solve the question from both the materials, because the query is from some students, not from all students. Even most of the students are enjoying this thing, but a few of you are having this issue. So definitely you guys can skip those things. So guys, we were doing the decision making and marginal costing. In last lecture we have done the break even point, and we have done one question on break even point as well. So what would be my target for today? I am basically planning to reach at that level, that from the next lecture onwards we can start the decision making, the main concept of decision making with full focus. Okay, so what is my plan for today? I'll basically tell you all the residual things which is there in your material related to marginal costing and decision making. Okay, we'll solve some of the questions other than the decision making. You can say the indifference point questions are there, the strategy evaluation questions are there. So we'll solve those questions. We will read the concept. We'll understand the terminologies related to decision making, which would be helpful for us in next 5, 6, or 7 lectures, which we will contribute to the decision making wholly, fully. And that is my target for the day. So let's start. Let's go to the material first. Let's see what we have done and what is pending in the material, whether it be the question or the topic. So I can say we were doing from marginal costing and absorption costing. We have done the marginal costing, what marginal costing is and what absorption costing is. We have done the difference between both of the costing. I hope you guys know the marginal costing is somewhere a traditional thing where, oh, sorry, absorption costing is somewhere a traditional thing where we used to take all the cost. But in marginal costing, we used to take only variable cost. Okay. So this thing we have already done in our last lecture. The advantages and disadvantages we have already done. So I don't think there's anything new in this. Yes, the differential cost analysis. Now, what basically the differential cost analysis is? So guys, we have done the marginal costing. In marginal costing, I've told you that marginal costing means variable cost. Marginal costing typically means variable cost where we do not consider the fixed cost element. But in differential costing, this costing is basically related to decision making. If I take decision making, I'll say differential costing because this is the costing which is typically related to decision making. Now, how this costing is different from marginal costing? Because in last lecture, I told you the marginal costing is also related to decision making. Then how this costing is different from marginal costing and how this costing is more relevant for the decision making purpose. So I would say that in marginal costing, we used to consider the variable cost only the variable cost. But actually in decision making, we consider some sort of fixed costs as well. We'll do in this lecture only that what type of fixed cost we consider in the decision making. Let's take an example. Let's suppose you are getting a new project of you are having the factory of making, suppose you are having the factory of making cream biscuits. Okay. And you are asked to make, I can say, um, the butter biscuit or yeah, butter biscuit. Okay. So you are having the factory of making cream biscuits and you are set to make the butter biscuits. Okay. And basically there is some sort of difference in the procedure of making the butter biscuit. I mean, it is somewhere additional you require for making the butter biscuit. Suppose one specific machinery you require. You know, all those example which I give you, I just look here and there in my room, and if I saw some sort of things, I make example on that. So don't see that why those idiot examples I give you, because these are related to real life. I mean, real life. I can say real things. So but these examples can be helpful for you to understand the concept because when we hear such type of weird things now it retain we our mind retain us for the long. Okay, that's why I try to give these type of examples. So basically in making butter biscuit you require a specific machinery. Okay, now you need to decide whether you need to accept this butter biscuit order or not. Okay. If you accept this butter biscuit order, you need to buy that machinery and you'll buy the machinery. I mean, this is the only project. I can say this is the only project for which you will require this machinery. After completion of the project, you do not need that machinery and you need to resell it. Now, this machinery cost, however, it is a fixed cost, but it would be considered in decision making. We will consider this machinery cost in our project cost. So basically, we'll consider all the variable costs for our decision making. We'll consider, labor, material in variable cost. I can say the labor cost, material cost, the variable overhead cost. I can say electricity cost, some sort of other cost. I can say that those all costs we will consider in our decision making, but along with that those all costs we will consider the cost of machinery as well. However, the cost of machinery is a fixed cost, but just think logically once that even if it is a fixed cost, but you are specifically doing it for this project, and after completion of the project, you do not have any option but to resell that machinery. So suppose you buy that machinery for 1 lakh, you are having the resale price of the machinery, you are estimating basically the resale price of the machinery 90,000. So what would be the relevant cost for the machinery? I'll tell you the concept of relevant cost as well. What would be the cost which we'll consider for the decision making? So suppose the person who is giving us the project of making the butter biscuit, he's saying that we will pay you 1 lakh rupees for 1000 biscuits, you can say, or 10,000 biscuits packets. They'll pay us 1 lakh rupees. So suppose my material cost would be 40,000, my labor cost would be 20,000, my variable overhead cost would be 20,000. Now, what would be my fixed cost, which we will also consider? So basically, my machinery cost is 2 lakh, suppose 2 lakh. Okay, my machinery cost is 2 lakh, and resale price of the machinery is 1 lakh 85,000. So basically, I will include 15,000 in this relevant cost, or I can say the project cost. So I'll say total 40, 20, 20, and 15. So I can say 95,000 rupees would be my relevant cost for the project, and I am getting 1 lakh rupees. So basically, I'm having the profit of 5,000 rupees. So I can accept the project. Now, suppose the resale price of the machinery. I hope you guys are noting these things down. If you guys want, you can note down the things. Like if you wanted to see it in future as well, you guys can note down. So suppose in second scenario, suppose the purchase price of the machinery is 2 lakh and resale price of the machinery is 1 lakh 75,000. Now, what would be the relevant cost for the project? So 40,000 material, 20,000 labor, 20,000 variable overhead, and 25,000 fixed overhead. So I can say 1 lakh 5,000 would be my relevant cost, or I can say the cost which I will incur for the project. Okay. And I am getting 1 lakh rupees only out of the project. So basically, what would be my decision? My decision would be to not to make, because I am having basically 5,000 rupees loss out of the project. So basically, this is the differential cost analysis. And this is the beauty of differential cost, that in marginal cost, we consider only variable cost. So if I go ahead on the marginal cost concept only, I can say that my cost would be 40K, material, labor 20K, variable overhead 20K. So total cost would be 80K. I am getting revenue 100K. So basically, I'm having the profit of 20K. But in differential cost analysis, we take in example we take in consideration basically relevant fixed cost as well, which should also be taken. Basically, if you think logically, a machinery which you are buying for 2 lakh rupees, and which is having the resale price of 1 lakh 85,000 rupees just after completion of the project. Just after completion of the project. So you are basically using this machinery solely for project. Then why the cost of this machinery? I can say what 15,000 rupees. Why it would not be considered? It would definitely be considered here. So I can say 15K. So I'm having the profit of 5K only in differential cost analysis. So basically, this is differential cost. I hope you guys got the point. So what is the difference basically in marginal cost and differential cost? We consider the fixed cost as well in differential cost analysis, and this is more logical than marginal cost analysis if I consider decision making thing. Okay. Now, practical application of decision making. These are, I mean, I don't think I need to make you understand the things. Okay. So you guys can read it once. Now, tools and techniques of marginal costing, or I can say the differential costing as well. So tools and techniques, what would be the tools and techniques? So we have already done this. Why we are taking contribution only in marginal costing? Because in marginal costing, we only consider variable cost. We do not consider fixed cost. And up to the contribution, basically, what is the definition of contribution? It is sale minus variable cost. That's what contribution is. So basically, nothing related to fixed cost is coming here. That's why the contribution is the only thing which is important for the purpose of marginal costing. Basically, we are doing marginal costing and decision making simultaneously. Okay, these both concepts are more like related to each other. I would not say interdependent, but it is related to each other. Okay, the somewhere decision making is dependent on the marginal costing, but not completely. Wherever that type of fixed cost come into the picture, the marginal costing goes out and differential costing comes in. Okay, so the contribution we have already done. What contribution is? Profitability the profit volume ratio, I think we have done this as well. The formula is contribution upon sales multiplied by 100. Now, what is the difference between contribution and PV ratio? So in PV ratio, we calculate contribution per rupee of sale. So basically, out of, like, if you are selling 1 rupee item, what contribution you will earn, that the PV ratio will tell you. Okay, so this is PV ratio. We have done this as well. Now, break even point. What basically break even point is? We have done this as well. Okay, break even point is a point where profit would be zero. There would be zero profit. Okay, so this is break even point. Now, angel of incidence. This basically angel of incidence is related to this. I can say this graph. The graph is related to total sales and total cost. So if you see here, at this point, total cost and total sale is equal. Total cost and total sale is equal. So basically, if total sale suppose is 1 lakh and total cost is also 1 lakh. So profit would be zero. Profit would be zero. So at this point, I can say we are having break even. At this point, sale, we are having break even. Okay. Now, after this, the sale is going like this and the cost is going like this. So basically, sale is increasing more rapidly and the cost is increasing less rapidly. That is the thing that usually happens. If cost started increasing more than sale, then why we will sell? I mean, you know, after this point, I can say that we are earning profit. After this point, I can say we are earning profit. Where suppose if my sale goes up by 2 rupees, my cost goes up by 1 rupees. So I'm having 1 rupee profit. So basically, this is the angle which is made between cost line and sale line. That is called the angle of incidence. Okay. So break even point. Now, what let me make you understand what basically CVP analysis is. You need to just think logically. The cost, volume, and profit. We are analyzing cost, the volume of sale, and profit differentially. Okay. And we are reaching to a conclusion. We are reaching to conclusion by analyzing all these things that, after this point, you will have zero profit. After this point, you will have this much of profit. So these all things are related to decision making, because while making any kind of decision, you need to consider all these things. You need to consider sale, you need to consider variable cost, fixed cost, volume of sales. You need to consider everything. That's why we are doing it before the decision making. Okay. Now, suppose there is increase in number of units or sale in number of units. What would be the basically all these things are saying that what would be the impact on break even point when these things would happen. Suppose increase in sale due to increase in selling price. So suppose sale price increase, then what would be the impact on break even point? So basically break even point which shift, I can say left side. It will shift, basically break even point will come down. Okay, why so? Because suppose earlier the sale price was 10 and the sale unit was 100. Now sale price became 12. So basically total sale value earlier was 1000 rupees. So suppose the sale price increased to 12, then how many units I need to sell now to earn the same sale price? Definitely it's a sixth class mathematics that this point will come down. The sale units will come down. Certainly I can say somewhere 80 or 80 to 83 or 85 I need to sell to reach the same sale price, and the cost amount is same. The cost would be same because nothing is given about the cost. So cost would be same. So basically, whenever the sale price is increased, the break even point shift downward or it shift, I can say left side in the graph. Okay. Now decrease in the variable cost. Suppose variable cost is decreased. Variable cost is decreased. So what would be situation now? So same situation would be there. Basically, the earlier, suppose I was having the contribution of 8 rupees. Okay. and I was selling 100 units. Now, since variable cost decrease with the same sale price, I'll have the contribution of 10 rupees. Suppose variable cost is decreased by 2 rupees. So with the same contribution, I'll have the sale price of 10 rupees. Okay, why? Suppose earlier the sale price was 10, variable cost, no, sale price was 12, and variable cost was 4. Now the sale price is same and variable cost became 2 rupees. So because of variable cost is decreasing, we are having more contribution. And since we are having more contribution, the uh, units, the units which I need to sold for the same amount of contribution would be decreased. It would be 80. Okay, and the fixed cost would be same. So what would be the impact on the graph by if the variable cost decreases? So if variable cost decreases, what would be the impact? The graph would shift left side again, or the break-even point will fall down. What would be the impact of changing in fixed cost? So suppose the fixed cost increases, fixed cost increases. Now the break even point would also increase because we need to sell more to cover my fixed cost. We need to sell more to cover my fixed cost. And if fixed cost decreases, what would be the impact on my break even? I need to sell less to cover my fixed cost. I hope you guys know what is the definition of break even point. Basically, a point where your contribution equals to your fixed cost. If fixed cost come down, you need less contribution. For less contribution, you need to sell less. So that is the thing. Okay. So if fixed cost goes up, you need to sell more, or the break-even point will go more. And if fixed cost come down, you need to sell less. So break-even point will come down. So this is the thing. Okay. The cash break-even point, what is this? Basically, we consider only cash things, only cash fixed cost and all those things. So PV ratio, profit volume chart, it's nothing what we have just done. Basically, we make a sale line, the cost line, the profit line. Okay. Now, just see the PV chart once. Okay. So this is basically the sale line, and this is the profit line. So at this point, your sale value, basically your profit is coming zero. Your profit is going zero at this point. Okay, so this point is called break even, where your profit is zero. I hope you guys know that whenever any business is started, we started from zero, but the cost, fixed cost, always there. Okay, so at the initial moment, you face some sort of losses. So this is that loss which you will face at the very beginning when you will start the business. At certain point, you will, cover your complete cost by sale. Okay, so but suppose at this point you will sell 35 units, uh, 35 units you can say. Okay, and 35 units is sufficient to cover your fixed and variable cost. So at this point I can say this would be the break even point where your complete variable and fixed cost would be covered by sale price. Okay, and after this point there would be in angle of incidence, which is basically created between total sale line and the total cost line. Basically, whatever profit you will earn. And suppose your sale is this, your current sale is this. So what is the difference between this sale price, this sale unit and this sale unit? What is the difference between these both sale units? This is called margin of safety. Now, what is margin of safety? Basically, break-even point is a point where do not earn any profit. Margin of safety basically shows that much unit which you are currently selling. So basically, suppose today you are earning 5 lakh rupees profit, and 5 lakh rupee profit, I can say, suppose this is the 5 lakh rupee profit you are earning. Okay, and this profit you are earning by selling, suppose the difference between 135 is 65. So by selling 65 units, you are earning, I can say, 5 lakh rupee profit. So 65 units is the margin of safety. Margin of safety is basically those sale unit above the break-even point which you are selling. So the sale units above the break-even point is called margin of safety. You can note it down. Sale unit above break-even point is margin of safety. I hope you guys got the point. Uh, Now, break-even point calculation, you guys know fixed cost upon contribution per unit. This is easy. Okay. Uses and application of break-even analysis, profit chart, and CVP. You can simply read it. I don't think that would be important. Limitation of break-even, just read it once. Margin of safety, I have already told you guys, margin of safety is the point above the break-even point. Now, the formula of margin of safety is given here. Now, let's break down this formula. So basically, I'm saying the unit which you are selling above the break-even point. So at break-even point, suppose this is the break-even point. At this point, your profit is zero. Profit is zero. Or I can simply say that your variable cost plus fixed cost up to this point is covered by your sale. Is covered by your sale. So I can say that above this point, your cost would be variable cost only, because fixed cost is only up to this. And even the variable cost up to this unit is up to this. I mean, suppose this is 30 units. So up to 30 units, you are able to cover your 30 unit variable cost and total fixed cost. Total fixed cost and 30 unit variable cost. Okay. So suppose after this point, you earned 5 lakh rupee. Okay, you are selling up to here and you are earning 5 lakh rupee. What would be your margin of safety, or what would be the sale unit which you are doing? So it is nothing but the profit which you are earning divided by PV ratio. Why only PV ratio? Because here in after this, the fixed cost impact is not coming. The fixed cost impact is not coming because fixed cost is covered up to here. It is covered up to here. Up to the break-even point, the fixed cost is gone and the variable cost up to this unit is gone. Above this unit, the variable cost of the unit which is sold after the 30. So suppose the 100 unit is totally sold, okay, and 30 is the break even. So I can say the variable cost of 70 units would be the only cost, would be the only cost. Okay, and the profit you are earning 5 lakh rupees out of this 70 units only. Okay, so I can say the sale value, whatever the sale value is of 70 multiplied by x, this would be the sale value. Okay, the variable cost, I can say 70 multiplied by, suppose the variable cost is 5 rupees. So it would be 350, and the contribution is equal to fixed cost now. No, sorry, profit now. The contribution is equal to profit because the fixed cost would not be there. The fixed cost role is over up to here. This is the point where fixed cost role is over. Okay. So whatever you will earn, that would be your profit and contribution even. So I can say the at margin of safety, basically while calculating margin of safety, profit is equal to contribution. That thing you have understood. Now, what is the formula of PV ratio? PV ratio formula is contribution upon sale multiplied by 100. Or even I would not say multiply by 100. Okay. Now, since profit is equal to contribution, this is the formula of PV ratio. Okay. And what is the formula of MOS, margin of safety? It is saying profit upon PV ratio, or I can say profit upon contribution upon sale. Okay. So how can I write it? I can say write profit upon 1 multiply by sale upon contribution. Profit upon 1 multiply by sale upon contribution. Now we know that after 30 units, or at while margin of safety we are calculating, I can say we completely eliminate fixed cost because we have left the fixed cost up to the break even point. After that, only variable cost would be there. So there would not be any concept of fixed cost. That's why the contribution would be equal to profit, because at the suppose contribution is 100 rupees. minus fixed cost, it would be 0 specifically for margin of safety. I'm calculating it only for 70 units. So fixed cost would be 0. So profit would be 100. So contribution would be equal to fixed cost. Sorry, profit. Contribution would be equal to profit. So I can simply write here, either I can write contribution or profit. Here I can write contribution or profit. It would be eliminated. What is left? Sale. So by this formula, you can get your sale. So I can say margin of safety, simple formula, profit upon PV ratio. This would be the formula of margin of safety, where you can simply arrive on sale. I hope you got the things, because this was just additional thing which I have just done. You don't need to write it in the exam. I just wanted to make the concept clear for you. Okay. So if you guys got the thing, how the formula came, it's very good. If not, no issue. Okay. So we have done up to margin of safety. Now let's see some of the cost, basically some of the terminology, I would say, that would be important for the for understanding the decision making. So uh, operating and service costing, I don't think this would be important. The trans Okay, so this is basically, this is saying different type of operating cost for different businesses. That would not be important. Okay, now just see relevant cost analysis. We'll see it from here. The relevant cost analysis. Okay, so what is basically relevant cost? Relevant cost is the cost which is relevant for the purpose of decision making. Cost relevant for decision making. Let me take an example that suppose I have the factory of mobile manufacturing. Okay, and I am said to make the calculator. I'm set to make the calculator. I have the factory of mobile. Okay, now for making the calculator, I need one machinery. Okay, I need to buy some material. Some material I need to buy. I need specific labor, and electricity would be there. Further, one machinery which is already there in my I can say factory, that would also be used for some time. So machinery which is already in factory would also be used. So basically I require two machinery. One is already there in my factory. One I need to buy separately for making the calculator. Along with this, I require material. I require specific, the labor with specific training. I can say I'll get those labor from the market, and I require electricity to run the machinery. What would be the relevant cost for making the calculator? Okay, so basically I'm getting a project. Okay, and the person who is giving me the project, he's saying that we will pay you 3 lakh rupee for making the calculator. Okay, now material which I need to buy from market is suppose 80,000. I need to pay 40,000 to labor. Okay, I need to pay 40,000 for electricity. Okay, the machinery which I'll buy specifically for making the calculator is costing 6 lakh rupee, and this machinery would only be used for making the calculator. Okay, if you guys want, you guys can note it down in in your own words. I'm just doing here to make you understand the thing. So I need to buy a specific machinery for 6 lakh rupees for making the calculator. And after completion of this project of making the calculator, I do not need that machinery further. So what I will do now, I will sell this machinery. So resold price of this machinery is, I can say, okay, 4 lakh 80,000. It is 4,80,000, which is the resale price of the machinery. And one machinery which is already there in my stock, the depreciation which is charged on that machinery is 40,000 rupee per year. So we are given this data. Okay, that data I just made from my mind. I mean, I didn't see, this is not a question, or this example we have just taken to, get the concept. So see, just a second. So see now, what would be the relevant cost? Relevant cost. What would be the relevant cost? Just see the material cost. Okay, whether material cost we are specifically doing for this project. Of course, yes. I mean, it is out of pocket cost, a sort of out of pocket cost which we are specifically occurring for this project. So I can say relevant cost. There would be material cost of 80,000. I can say labor cost, because we are, having labor. We are, you know, occupying labor specifically for making the calculator with that specification. So labor cost would be 40K. The electricity cost would be 40K. Okay. Now machine cost. The machine cost which is relevant cost of machinery would be 120K only. Okay. Now why 120K only? Just see that 60,000 is the price at which I'm buying the machinery. I will use the machinery specifically for the project of making the calculator. After completion of project, the machinery is of no use for me. And what would be my further move for the machinery? I will sell this machinery further. And after selling the machinery, I'll get 4,80,000 out of the machinery. Okay. So relevant cost would be the difference between the purchase price and the resold price. So basically, I am costing, basically the cost for me of the machinery is 1,20,000 rupees only. So this would be the relevant cost for me. Now, where this depreciation cost for the machinery, which is already there in my stock, has gone. Suppose, just think once, what would be impact on this machinery, or I can say depreciation of the machinery, if I do not take the project? If I do not take the project, what would be the impact on this machinery, this 40,000 one, this one machinery? What would be the impact on this machinery if I do not take the project? So guys, if I do not take the project, there would not be any impact on the machinery. The machinery would either be idle, okay, because in the question it is not given that we are taking the time of some other product and we are giving the time of the product to this machinery. Basically, this machine was idle. We are using it for the purpose of making the calculator. Okay. What would you basically additionally costing for using the machinery? I would say nothing. If you do not take the project, the 40,000 depreciation would still be there. If you take the project, the 40,000 depreciation only would be there. Then why you are charging that 40,000 for the project? Here, suppose if I do not take this 40,000, my relevant cost would be 280K. Okay, my basically sale is 3 lakh K. So I am earning, I can say 20,000. So this is a, this is a good contract for me where I'm earning 20,000 rupees. Suppose I consider the 40K depreciation here, suppose, which is completely wrong. So my cost would be 320K. My sale price would be 3 lakh K. So I would have, now I would have 20,000 rupees loss. Okay, if I consider this depreciation, but just think logically, I am not costing anything else. Why should I leave the opportunity to earn 20,000 rupees? Definitely the repair maintenance thing would be there if I use the machinery. Some people may say that the repair maintenance of this machinery might increase, but that those all things will come in the variable cost. That will not come in the fixed cost. I'm specifically talking about the depreciation, so focus on depreciation here only. Why should you take this 40,000? You should not take this 40,000, because just think logically once, what you are losing, what you are losing by using this machine, what you are losing by using this machine. If you're using this machinery, you're losing nothing. If you do not use machinery, you are gaining nothing. So there would not be any change. So this cost would be irrelevant cost. This cost would be irrelevant cost. So the relevant cost would be 280K only. My sale would be 3 lakh K only. I would earn 20,000. So this project would be beneficial for me. So this is the concept of relevant costing. I hope you understood the concept of relevant costing, that which cost would be relevant, which cost would be irrelevant. So relevant cost would be that cost which would specifically occur for the project, and which would, when we'll think logically, you'll definitely find whether this cost would be relevant or not. If you are specifically accruing a cost for the project, okay, and you can save the cost by not doing the project, you can say that cost is a relevant cost. Okay, now, these are some of the definition of a fixed cost. I can say relevant cost, which is given to us, that the cost should be future cost, it should be incremental cost, and should to affect the cash flow or not affect the cash flow, whatever that is. So these things are given to us. Okay, I don't think like we need to read it, because we have already understood these things. Now just see the example. Let's see it once. Just a second. So the company A manufacture bicycles. Okay, it can produce 1,000 units in a month for a fixed cost of 3 lakh rupee and variable cost of 500 per unit. The current demand is 600 units, which it sell at 1,000 per unit. It is approved by company B. Okay, it is approved by company B for an order of 200 unit at 700 per unit. Should the company accept the order? Should the company accept the order? Now, you guys just tell me, should the company accept the order? I would say definitely company should accept the order. Why? If you'll take in consideration this cost as well, you will say the company should not consider. But this cost is irrelevant cost. This is the sunk cost. This would not change whether you accept this order or reject this order. This would be similar. Definitely, the variable cost would change. The variable cost would change. For next 200 units, the 500 rupee per unit cost would increase. So I will say we will take variable cost only for the consideration, and by accepting this 200 units, we would be able to earn 200 rupee per unit, or I can say per bicycle. Okay, so my total profit by accepting this project would be 200 multiplied by 200. 200 bicycles, and per unit you are going to earn 200 rupees. So I can say 40,000 would be your profit by accepting this project. So whether you should accept it or not, definitely you should accept it. So differential cost, marginal cost, we have already done. Now, these are some of the concept which is given. So let's read the concepts. Just a second. Okay, so opportunity cost. What is opportunity cost? Basically, opportunity cost of losing benefit, losing benefit. This thing we will understand in deep when we do questions. But let me make you understand one thing once over here. Suppose, um, okay, suppose the material. Suppose you got a project. Okay, for that project you require material A. The material A is nowhere available in the market. Okay, and that material is only available to you, and only 100 units of them, that material is available to you. Okay, so basically what I said, that you require 100 units of material A for completing specific project. That material is nowhere available in the market. That raw material is nowhere available in the market, but eventually 100 units is available to you. Okay, but but twist in the story is that those 100 units which is available to you, that you are planning to use in project B, some other project, and from there you are going to earn 20,000 rupees by using that material in project B. You are going to earn 20,000 rupees. Now suppose you use that material in project A, in my project which I'm evaluating. Suppose you use that project in this that material in this project, what would be the consequences? You would not be able to earn 20,000 rupees from project B. So basically, by using the material A in our project, you are losing 20,000 rupee profit in material in project B. So what would be the opportunity cost? Opportunity cost would be 20,000 rupee, or I can say the cost of losing benefit. Whatever you are losing by using the project in another somewhere else, that would be the opportunity cost. Okay. Now, avoidable cost, basically that cost which you can avoid, or you can, choose some alternative instead of using that specific cost. That is called avoidable cost. Now, replacement cost is cost of replacing one thing by the other. Okay. Imputed cost is that cost which basically has not occurred till now, but that would be occurred. Okay, so it is definitely a relevant cost, imputed cost. So we need to take imputed cost as well in the consideration while solving any kind of decision making concept, and replacement cost as well. So what basically replacement cost is suppose what replacement cost is. One more thing, I mean, I just got that some people are saying that, and I used to speak very fast while uh, you know making while analyzing something to you. But the thing is, I most of the students are from either next exam or next to next exam. So the things are coming closer. Okay, the exams are coming closer. That's why I just wanted to wrap it up early so that we can start with our practice. But since you people are saying that I should speak somewhere uh, slow. So I would definitely speak slow from next lecture, or I can say from this lecture as well. I have tried to improve in last 4 to 5 lectures. If you see, I am speaking slowly. Okay, but still, I don't think I should go slower than this, because then after if I go slower than this, then you guys will probably sleep. Okay, so I think this speed is okay for you guys. Just let me know. Okay. um, Tell me whether I should be more slower or this is okay. Okay. So replacement cost, what basically replacement cost is, suppose the material is available to you. Okay. Or I can say mm, anything which is available to you and which can be replaced at certain cost. Okay, that is called the replacement cost. So I can say the current market price of something is the replacement cost. Why it is important, you will see this when we'll solve the question related to decision making. I can say in some material things, the replacement cost concept would be there. Okay, now out of pocket cost specifically occurring for the project, so it would be a relevant cost. Okay. Now, what would be the irrelevant cost? I can say sunk cost, which is already committed. Okay, you are not occurring that cost specifically for this. The cost have already been occurred. So this is called the sunk cost. So it would be irrelevant cost. Committed cost basically here it is written that committed cost is an investment that a business entity has already made and cannot recover by any means. Since this cost also has been done, this cost also has already been done, so it is not a relevant cost, so it would also be an irrelevant cost. Absorbed cost, I can say those costs which which has already been absorbed, or which has already been taken into consideration. However, it would somewhere feel like non-fixed cost, but absorbed cost would also be irrelevant cost. So here an example is given like insurance cost or property tax cost. So I can say that insurance cost of building would not change with my decision of accepting the project or rejecting the project. It would be same. So it is irrelevant for my project because I do not need to add in my project cost the absorbed cost or insurance cost of the building because it has already occurred. It was not changed with my decision. Okay, so I hope you got the thing. Absorbed fixed cost. Okay, now relevant cost of material. This thing would be important because this is the ultimate thing which would be useful for solving the questions. So we will, what we'll do, we'll basically do some relevant cost for material, labor, and all those. So let's see once relevant cost for material. Now see the case one, opportunity cost of material already purchased and having no other use. Okay, in current production process having no resale value. So what basically this example or case one is saying, suppose material A is you require material A for making some project, or for some project you require material A. That material A is already there in your stock. That material A having no resale value, it is of no use. I mean, it is just there in your inventory, and now you got a project that you can use that material A at least somewhere. Now, what would be the relevant cost of that material A? I would say nothing. Suppose if material A is having some resale value, then that resale value can be said as the relevant cost because we are losing by applying that material A in a project. I am losing what I can gain by resell the material. Suppose I can sell the material A at 10 rupees. Okay, but since I'm using it here in my project, I'm not able to get those 10 rupees. So what would be the relevant cost for the project? It would be 10 rupees. My resale price, basically, I can say. Just keep your mind open while doing decision making question. This topic is easiest topic, but the most difficult one. If you are not aware while you know while we are reading, while we are solving the question, it would be most difficult for you guys. And if you are aware, nothing is easier than this topic. Okay, so I can say the resale value. If the material has having some of the resale value, the resale value would be my relevant cost. And if no resale value, then basically the relevant cost would be nil. So basically the material is of no use. If it is having no resale value, if I'm using it nowhere else, means it is of no use. It is just there in my stock. Okay. So what would be the relevant cost? Relevant cost would be the basically relevant cost would be nil if we are having no use of the material. Opportunity cost. Let's see case two. Opportunity cost of material already purchased and having no other use in current production point, but having realized it. So we have already done this. I have told you both the scenarios. Opportunity cost of material required under proposed production. Only some portion thereof is held in stock out of purchase and having no other use in current production process, but having realizable value. So same thing, the realizable value or resale value would be the cost, relevant cost, I would say. The opportunity cost of material already purchased and held in go down and having regular use in current production process. So basically, suppose material A I require for some project. Now material A is already there in my stock, but I use that material A in my regular business. Suppose I take that material A from there and use it in my project. I need to buy that material for some other project. I need to buy it again. So basically, what I can do, I can either purchase the material directly from the market because the material which is already there in my inventory, I am using that material somewhere else. Okay, that material is, however, it is there in my inventory, but that material we are using in my regular business. So you cannot take the material from there If you'll take the material from your inventory for your regular business, you need to buy it from outside. So the thing would be same. I mean, you know, the relevant cost would not change because you know you either need to buy for this project or for the regular business, but you are spending just because you are taking the material from your inventory. So what would be the relevant cost? Relevant cost would be the cost of the material, or I can say the purchase price of the material. I hope you got the point. Suppose you require 10 kg raw material, the 20 kg raw material is there in your inventory, but that 20 kg is required for making day-to-day inventory, or fulfilling the day-to-day business things. If you take 10 kg from there, you need to buy for the daily business from the market. You still need to you know uh, you still need to I can say spend the amount for buy the material. That's why I am saying, if that material is regularly used for the normal business scenario, you the relevant cost for you would be the cost of the material, or I can say the purchase price of the material. I hope you got the point. So the case 4 is done. What is case 5? Opportunity cost of material already purchased and held in godown and having regular use in current production process as a substitute material. So the same thing is here. Opportunity cost of material already purchased and having no other use in current production process, having no realizable value, but can be disposed by incurring some additional cost. Now this is important. Suppose material A is there. Okay, now that material A is nowhere used in my current production process. It is like of no use for me. Okay, it is having no realizable value, resale value. But that material A is toxic material, very toxic material. And uh, you know, uh, there are many environment act like Environment Protection Act 1986, Wildlife Protection Act 1972, which say that you cannot dispose the toxic materials. I mean, anywhere. I mean, you need to follow a specific process for disposing of the toxic material. Okay, so that material A you need to dispose of as per the government regulations. Now, for disposing of that toxic material as per government regulation, you need, you require, uh, you need to hire one person who can, dispose of the material for you. You need to buy specific chemicals so that that toxic material do not pollute the environment. These all costs you need to occur for disposing of the material. Okay, for disposing of the material, you need to pay the amount. Now you got a project. That project is saying that you can use that material, that toxic material in that project. Now, what happened? Basically you saved the amount which you need to pay for the chemical, or I can say for the person to dispose of the toxic material. So, what would be the relevant cost for the uh, project? The relevant cost would be saving. I would say saving in disposing of charge, disposing of cost. So basically you are having saving by accepting the project. You do not need to cost anything, but saving is occurring just because you are accepting the project. So what would be the relevant cost here? The relevant cost would be in negative. Relevant cost would be in negative because in actual you are saving the things, you are not losing the things, you are not paying something just because you are applying that material in your business. You are saving the things just because you are applying the material in your business. Okay, so basically there would not be any cost, there would be any saving, there would be some saving basically. Okay, so we will here write saving instead of cost. So case 7, opportunity cost of material, saying A already purchased and can be used after suitable alteration of other materials, say B or can be disposed of. So simple thing, either you can say the price of material A or the price of material B up to it is made equivalent to material A. So basically you need to change the material B somewhere so that you can make it similar up to product material A. So whatever the cost would be, that would be considered. Now let's come to the labor cost. What would be the relevant cost in case of labor? So suppose I take the casual labor for my project. So if I take the casual labor, so labor cost would be my relevant cost because I'm specifically hiring the labor just for the project purpose. Okay, so my labor cost would be the cost which I'm paying to the labor. In case of permanent labor, it is important. In case of permanent labor, so in permanent labor, the thing can be that the labor, you know, your permanent labor basically is the labor which always used to be there in your business. Okay. So suppose in case of permanent labor, the first situation is that the labor is free. The permanent labor is free, doing nothing, and you got a project. So what would be the relevant cost here? The relevant cost would be nothing because you are paying nothing additional for the permanent labor. Suppose permanent labor is working on overtime. So what would be the relevant cost? I can say overtime cost because this is the amount which you are paying additional to the permanent labor. I can say permanent labor is working somewhere else, and you are basically using those labor over here rather than that other project. So what would be the relevant cost somewhere else? So it would be the opportunity cost, or I can say profit lost in that project just because you are using the labor over here rather than there. Okay, so the third thing is done, first thing is done, second thing is done, something else. Let me see. I don't think anything else is here. If something else would be there, we will definitely, the thing would be definitely solved in the question because as I said, I am going to take 8 lectures of 1 hour or 1.5 hour on decision making only. Why I'm saying I'm taking so long time because you can now feel how important this topic is. Okay, so in next 7 to 8 lectures, we'll solve mostly questions. Okay, the questions only would be there. I don't think I need to elaborate the things more, but the questions would be there. So by question, we'll understand the things. Okay, so that's why I'm just making the things elaborate. I'm elaborating the things once, not very deep, because in deep we'll do in the questions. Now, some of the examples are given. I don't think I need to do this. Okay, for fixed now, what would be the relevant cost for fixed overhead and variable overhead? In fixed overhead, I have given you the situation that if you are purchasing it specifically for the project and you need to sell it just after completion the project, that would be relevant. And irrelevant, which is unavoidable cost, basically I can say not unavoidable, I can say the sunk cost. Suppose the machinery is already there, so depreciation of that machinery, that would be sunk cost or irrelevant cost. Variable cost would be same as labor cost. If you are specifically occurring um, for the project, that would be relevant. If you are not occurring specifically for the project, that would be irrelevant cost. Okay. Now classification based on the cost for management decision making. We have already done marginal costing, differential costing, operational costing, opportunity cost, sorry, replacement cost. I have told you relevant cost. I have told you imputed cost. I have told you notional cost. I can say sunk cost. I have told you normal cost, abnormal cost, normal cost, which normally occurs in that scenario, and abnormal cost, which is unusual cost or which is occurring, rarely. That would be abnormal cost. Avoidable cost, which could be avoided by you can replace it with something else, or that could be avoided. But unavoidable cost, which would definitely occur, so that would be relevant. Okay, uniform costing, engineered cost. Engineered cost is basically cost of changing the input to output. That cost would be there. Out of pocket cost. Out of pocket cost is the cost which is specifically occurring for the project. Okay, you are paying it from your own pocket. So as the name suggests, out of pocket cost is, I can say, the cost which is specifically occurring for some of the project. Okay, and you are paying it. Managed to cost, common cost, controllable, non-controllable cost. So all these costs are easy. I don't think I need to elaborate more. So guys, we have done all the things. We have built up basically on decision making. In from next lecture, we'll start the typical topic of decision making. But I think I have told you to some of the questions other than the decision making are also pending. So basically, we have I have make you understand the topics, the theory, which is important, very important for the purpose of decision making. I have made you understand the concept related to decision making. But from next lecture, we'll start the typical topic of decision making. I can say how many type of decision can be there. I can say, sell or further processing decision, optimum product mixing decision. Okay, outsourcing decision, shutdown decision, pricing decision. So all these decisions would be there. But some of the questions other than decision making is pending, like here. So what I'm planning. So basically, in next lecture, what we'll do, we'll solve the questions other than the decision making. And from next to next lecture, we'll start with the decision making. Okay. So I told you at the beginning that from next lecture we'll start the decision making. But since uh, you know making you understand the concept is more important, so it took me a lot of time. I think around 1 hour has happened. So in next lecture we'll solve a few questions other than decision making. I can say in different point questions are there. Okay, I can say some of strategy related questions are there. So we'll solve those questions. We'll see all the questions first. We'll see which questions are pending and which questions are other than decision making question. We'll solve those questions in the next lecture, and from next to next lecture, definitely the typical decision making thing would be started. So I hope you have understood the things. Definitely, for any doubt, just let me know. You guys have my mail ID AAYUSH090198 @gmail.com. Just let me know once you join the course. Share your WhatsApp number with me so that I'll add you to some WhatsApp group, or either on the WhatsApp group I can add you, or we can have an interaction without the WhatsApp group as well on the WhatsApp conveniently. So you can ask your doubts there, or these all things could be happening. So guys, this is all from my side for the day. In next lecture, we'll do some questions other than decision making. And from next to next, as I told, we'll start the typical decision making. So thank you so much. Have a very nice day. Bye.